Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to the U.S. Markets Wrap with me, Ryan Huang. And we've got some, mixed sessions, or at least a mixed look at the latest session. The Dow Jones Industrial Average higher, the S&P 500 little change, and the Nasdaq Composite also lower. And that comes as Fed Chair Jerome Powell went ahead with a 25 basis rate cut as expected. And he also tempered enthusiasm a bit by signaling that the move was not the start of a long rate lowering cycle. So let's get into it with Ben Emons. He is the Chief Investment Officer for FedWatch Advisors. Good morning, Ben. How are you doing today?
Good morning, Ryan. I'm great.
Yeah, great to have you on. Lots going on. So let's talk about a rate cut and what they expected. And they've signaled 2 more cuts by the end of the year. What do you think is driving this policy stance right now? Would you describe it as aggressive?
I wouldn't describe it as aggressive, Ryan, but I would describe it as the way Powell said himself. This is a risk management cut. So he put a lot of emphasis this time, like last year, on the unemployment rate, that they're looking at that forecast and say, at 4.5, that's sort of the line we want to draw there. We don't want that to go higher than 4.5. And it shows that forecast actually declines in 26 and 27. And I think there's really the action that they're taking as announcing that they did this rate cut today and they're going to do 2 more rate cuts. And it's going to very likely happen. So there's going to be a series of cuts. But then by 2026, there was the compromise to just leave 1 cut there in case that inflation stays higher, right? So I think this is a meeting where they said, let's do risk management on the employment side of the mandate, but let's also not forget about inflation and keep an eye on that, how it develops into 2026. That was sort of the outcome.
Yeah, so there's that dual mandate by the Fed, looking at both inflation and the labor market. And looking at the labor market, it's been seeing some sluggishness in recent times. Where do you see things going, especially with tariffs hanging in the air right now?
Well, there was definitely discussion that tariffs are actually impacting the economy, that it slows down the economy and therefore causes somewhat pressure on the labor market. And so, on the other hand, you get tariffs that do show up in inflation data. And so that probably is going to stay this way for a bit until we have totally the final trade deals in place, which more or less are happening now with most countries except for China, which is continuing to be pushed out there. And so the story at some point will change. The tariffs are what they are, and the economy's adapted and adjusted. And that's what the Fed also expects in their forecast. They think that the economy will pick up again by next year into 2027, 28. That seems a long way from now. But it's sort of the idea, right? Lower rates now, give the economy some stimulus, the tariffs are being absorbed, and then things hopefully turn better again. That's the forecast at least, but that seems more that how the markets are trading that too, with that idea.
Yeah, the other part of the equation that folks have been watching is how many dissenters we would get this time. The last time we had 2, now we have 1, 11-1 is the vote. Any surprises here?
Well, the big surprise was that Stephen Moran, who was just appointed to the board literally 24 hours ago, so he dissented with 50 basis points. He made the case that the Fed should have lowered rates today with 50 basis points. That was, by the way, also our call at FedWatch. We also made that call too because it's really about risk management. Try to really make sure that the unemployment rate doesn't go higher from here. But Moran also made this case through the projections that rates should be substantially lower from here. For both this year and next year, he's at the lowest projection from all. So there's a bit of this political message there, right? As in, you will be there for 4 months. You will kind of pound the table on, come on, Fed, let's lower more, and let's push the economy more. Of course, it's all for the midterms that are next year, right? So, as compromise, the Fed said, yes, we'll lower rates, but not as aggressively as you want. So that's why you dissented.
Yeah, not as many dissenters as the last round, but it does still show, looking at a dot plot, a wide range of views. How much confidence should markets be placing in these projections? And does this divergence of opinion, in some sense, affect market sentiment?
Well, it initially does, but then once these projections are out within the next week or so, nobody's really going to care too much about those anymore.
Okay, something else we are tracking is how that's playing out in the markets, and we've been seeing how some of the small caps have been doing well. That seems to be providing some tailwinds for markets. Is this going to mean perhaps more upside for the broader markets in time to come?
I think it's still good because this meeting was one that has happened before. In 1992, they cut by 25 basis points, and it had the center through for a larger rate cut. And the economy sort of started to take off again in 92, 93, sort of the election effect, I guess, too. But it was it's kind of like now, where we have an economy that starts to show signs of some acceleration. So cutting by 25 is still stimulus. And by cutting more after that, in October and December, more stimulus. So yes, the small caps should continue to rally.
Yeah, so we did see the big tech names start to pull back. Would this then be the signal for investors to start rotating away from that space into some of the broader market players like the small cap space?
It could be because, it has been happening, but not in such a major way yet, because the data or the earnings from big tech, particularly those who are really spending on AI or investing in it, are still the big driver of this market, right? It's a lot of concentration. So, but if it becomes a broadening rally because the economy picks up, because the Fed is lowering rates, then yes, you could rotate away from some of the overvalued tech stocks into small caps.
Okay, and a recap of where things are right now. The Fed's just announced a rate cut, signaling 2 more by the end of the year. Ben, where are you sitting on this projection? Are you looking at the same sort of level of cuts?
I would be, although I still think that this Fed, if it gets to, if push comes to shove and we're getting a bad unemployment report again, the next one, I do think that this Fed will be inclined to go for bigger rate cuts. And they should basically do it in one meeting for what they plan for the rest of the year, simply because they don't want that unemployment rate to go higher. Other than that, I think this forecast is fair, and it then depends on how the economy plays out next year. I'm bullish because I think that there's a lot of investment coming into the economy that should at least drive productivity higir, and the Fed could then eventually be a bit sidelined again for a while. So kind of repeating what happened in the 1990s, right, where we sort of hike very aggressively, then cut rates a little bit, stay on hold, cut rates in between briefly, and then sort of stay on hold again. I think that's where we're in still. We're kind of repeating that era again.
All right, lots to watch out for in the coming weeks and quarters as we see how this plays out for Fed rate cuts in time to come. And helping us out this morning has been Ben Emons. He's the CIO for FedWatch Advisors. Ben, thank you so much for time and insights. Always great chatting with you.
Same, Ryan. It was great to be on. Thank you so much.
All right, we'll catch up with you again soon. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.